Hi, this short video presentation is going to compare Plan A versus Plan B, and which of these two retirement plans do you prefer? My name is John Barker, and I'm the managing partner of WMC Business Services, LLC. First off, we try to teach all of our clients and prospective clients to plan for your entire retirement. That's pre-retirement as well as post-retirement. So first off, most of the time people, as they go in to learn about retirement planning, all they really focus on with many individuals is how much they can accumulate. Now, with doing that, they sometimes don't look at what the consequences are of where they put their money and how they put their money and what it will do to them during their retirement. So what we try to teach is what you do today can have an impact on what you have tomorrow and what you can use, and to make sure those things are balanced. So first off, Plan A. Plan A is versus Plan B. Now, Plan A is the typical 401k IRA environment. So first off, I'm just showing $1 million here. We want to accumulate $1 million. That could be low for some individuals. That could be high for some individuals. I just put something out there that's easy to compare. So if we're going to accumulate, what we try to do is we invest. We put it in the stock market and mutual funds or whatever, and we try to make sure that we can get a good return on the money that we put in. And because of that, the higher returns we go after, we take moderate to high risk of investment risk. And that means that it can go down. And later I'll show you why that's very, very important. Now, there are 7 other major risks of retirement planning. And if you're not aware of those and you're not planning for those, you're taking moderate to high risk on those as well. Now, at the end of the day, let's say you get your $1 million and you go to retire at age 65, and you go to use that money between taxes and inflation just alone, just those two alone, if you live to 85 to 95 and go through that retirement, you may only get to spend $600,000 to $800,000 of the $1 million that you have accumulated because of those two issues alone. Now, let's look at Plan B. In Plan B, we teach our clients and prospective clients to maybe not accumulate quite as much, but we assume very, very low risk of investment loss or even no risk of investment loss, and we address all the other 7 major risks of loss. But at the end of the day, where we teach them to put their money will allow them, if they live to 85 to 95, and that's how long, 65 to 85 to 95, they go to retire, we show them how they will have $1.5 to $2 million, most of the time income tax free, to use in their retirement. Now, a lot of people say that sounds way too good to be true. I've been teaching this since 1987, and I also teach the IRS codes that make Plan B possible. So part of what we teach in all of our strategies as we help people through the full retirement planning is the concept that Warren Buffett has. And his #1 rule is never lose money. And #2 rule is never forget rule #1. And why is that important? Well, first off, if you're invested in anything that is market related, the market does go up, and luckily it goes up more than it ever goes down, and that's a good thing. But it does go down, and how can that impact you? So most people look at 2003 and they want to go after the 26% returns, and 2009 with the 23, and the 2013 with the 29, and even the 12s and 13s in 2006 and 2010. But they take as a consequence of getting those higher returns 2008, where it goes down 38%. Now, that doesn't mean they like it to go down. They just don't know what the impact of that means to them in the long-term planning for retirement. Now, compound interest is such a powerful tool that Albert Einstein once called it the most important invention in all human history. And I'm going to show you a couple scenarios. Let's just say we take $10,000 today and we invest it. We can get 7% every single year on our money, which is, that's difficult to do, but in this scenario, it's to demonstrate for demonstration purposes. But what can that $10,000 grow to after 65 years? That $10,000, if we can get 7%, will grow to over $800,000. Now, if it can grow to that, how does that make any sense when we take into account what the concept of never losing money from Warren Buffett? When you have a financial loss within your retirement, there's a larger impact to you than you have been taught in the past. So let's take a scenario where you're 30 years old, and it's like what happened in 2008. You lose $10,000 within your 401k or your IRA. Now, most of the time they say stay where you're at. You haven't lost anything. It will come back up. And you saw that the stock market comes back up. So yes, you recover that loss at age 31, and you're back to the same place that you were at before, before you lost the $10,000. But did you lose, or what is the impact of that over your lifetime? So you didn't lose just $10,000 for 1 year and make it back. What you lost is the earning capacity of that $10,000 for the rest of your life, because that is earnings you can't have. Now, if you hadn't lost the $10,000 and you made the $10,000, you'd have $20,000. But because you lost the 10 and you made the 10, now you're back to where you were at. Now, take that into account from compound interest, where we said that if you put $10,000 away, got 7% on your money in 65 years, it works the same way against you when you lose money. You take that $10,000, you get the 7% that you could have earned if you didn't lose it. 65 years later, that could have an economic impact if you live to 95 of losing $800 and some thousand on that $10,000. That's what losing money means. Now, if you're not 30 years old, if you're older and you lose money, doesn't matter. The concept is the same. You take 10,000, if it's 10 years, 20, 30, 40, there's an economic impact. Now go back and think, if you lose 10,000 when you're 30 and you make it back, but at 35 you lose 5,000, and at 40 you lose 15,000, and multiply those out till age 65, and that's the true importance of never losing money. That is an astronomical event that can happen long-term to a long-term planning solution like you're trying to do with your retirement. That's what we try to teach, how to balance. By taking those other 8 major risks and making sure we don't lose money in those other 8 major risks, either before retirement or after retirement. That's what's important. So before retirement, we have influences like taxes, accumulation pressures, market and financial risk of loss, and we try to avoid risks as best we can. But we also have that in post-retirement. When you're in retirement where you cannot make more money, it's even more important to make sure that we don't mess things up at the early stages, because you don't have the earning capacity in a normal situation when you go to retire. But there's still taxes. You need to make sure you have enough money until you die. There's inflation risk, financial risk, depending upon where you have it. And we're trying to avoid risks in post-retirement. It's important to balance that. One of the major things that I ask people, which is most important to you? How much you accumulate, or how much you actually get to spend and use during your retirement. And most of the time people say, how much I actually get to spend and use. Now, what do we do? If you're an individual who already is in a Plan A, no matter where you're at within your retirement process, early stages or late stages, how can we incorporate some concepts of reducing risk, making sure there's no risk of loss, and the concepts of Plan B? You can put Plan A and Plan B together to minimize that risk and balance that. Now, for some individuals who have not started Plan A, Plan B might be the right solutions, like the family member that I put that scenario for, where they went into Plan B only. Now, what about for companies? Companies offer retirement plans out to their employees. They have some things specifically called a fiduciary responsibility. We can offer Plan B side by side with your Plan A. And what it will allow for is limiting large losses within a retirement plan. Allow individuals on their own to decide if Plan B fits within their scenario. If 1 out of 100 chooses that, that's okay. What it also allows for is the educational requirements for a 404C requirement, and it can limit the fiduciary liability just by offering it, because that's what this education does. It's not right for everybody, but for those it is right for, it's extremely important. It doesn't matter if you're a 9-to-5 employee planning for your retirement, or a doctor or professional. The concepts are the same. The dollar figures might be different, but the concepts are the same, and you need to see how that can benefit you. The concept of no losses and the concept of the IRS code that allows you certain pieces of information and unique tools for your retirement. You need to see if that will fit within your strategies for your retirement. Now, here's just a hypothetical. This is what I ran out for a family member. We showed they're at 35. We projected out to 65 and their retirement. We showed in the 401k IRA environment that they could accumulate $1,234,827. And then they would want to take an annual income out of about $75,000. Now, because of where we put it, that $75,000 would be taxed. In this scenario, depending upon what they could get on their return, they would run out of money somewhere between 20 and 22 years into their retirement. Now, Plan B allows for a different accumulation. We only accumulated $934. But when it comes down to IRS calculations, this is something, an algorithm at the IRS that allows for calculations of yearly income to be started with a calculation of $2,169,551. And the same yearly income, but if we structured this correctly, there's no income tax on that $75,000, and the money would last up to age 100 and even past age 100. So side-by-side comparisons, we don't accumulate as much. We take out the same income, but look at the difference in what we could potentially use and spend. In Plan A, $750 to $1 million over that 22 years before it runs out. And in the other scenario, Plan B, $2 million to $2.6 million, and there would still be money at age 100. It is important that everyone at least understand these strategies, how to reduce risk of loss, no matter if you're in Plan A or not, and if you never look at Plan B. But the strategies are important for everybody to at least understand what they have available to them through the IRS codes and through their employer, what they're doing on their own, to get the very safest and most secure retirement possible for everyone. Now, if you would like an individual consultation, please contact me. We can set something up to talk individually. Or if you'd like to see when the next webinar that we have that explains Plan B in full, please contact our office and we'll get the information to you about the next available webinar. Thank you very much for your time, and I do look forward to helping all of those who would like to see a safer and more secure retirement in their future.